Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
A passive accumulator. What are the pros? Well, does it require a lot of time? Do you got to obsess over your portfolio every single day? Anybody? You're all saying no. No. What are you obsessing about, right? You're just watching grass grow. I mean, it's boring. Okay. It's worked well over time. Well, what the heck does well mean, right? I don't know. Some people, it probably hasn't worked well over time. It's delivered maybe what you would expect it to deliver if you stay in for the super long run, right? Doesn't require any prognosticating, predicting, or prophesying. No chart reading, market timing, or offering to the gods. It's not even a part of that approach, right? Okay, who's stoked? Who thinks these are just the best pros ever? I'm with Marquise, kind of meh, average. You're kind of accepting mediocrity is what you're doing. I don't know. Probably not going to get you excited to get out of bed, right? Okay, so what are the cons? What are the cons? Well, I mean, you get whatever the market's willing to give, right? It's kind of out of your hands, right? Kind of out of your hands. If it's a good year like 2013, right? I mean, that's pretty good. 2013 was great. Stock market went up like every single week, 20, 30% gains, right? The problem is you get years like 2008 where it takes all your money. Your account value goes down 50% if you're all in stocks. And so those bear markets, those are really what scare people. Seeing your assets drop, get cut in half, spooks you, okay? Not to mention volatility will drive you batty on occasion. Another pro is, yes, I mean, it is better than cash in the long run. Bonds and stocks generate better returns for sure, okay? If you can stomach the volatility, right? So like the volatility in the bear markets, that's like the price you have to pay to get the reward, at the end of the rainbow, okay? So I suspect most people here, this really isn't why you're seeking education, right? Probably not why you're seeking education. It's probably that you want to do better. You want to be more engaged. You want to try to, have less volatility, higher returns, et cetera, right? Because the reality is, if you had $10 million and all you needed was $300,000 a year, you could go buy 10-year treasuries that pay 3% and call it a day. But the problem is most people don't have $10 million and most people need more than 3% a year, right? And so it's like, look, getting the risk-free rate would be fantastic if I was sitting on a mountain of cash. But my mountain's not big enough yet. Or I want to be engaged because I like being engaged. And I want to be an active type of speculator because I enjoy the game, right? All right. I'm not sure that I'm the one that put this yellow line on here, Noah or Cam, or this pink line. It is pretty, but I don't know if there's like a way to clear the screen if somebody accidentally drew on it, but I don't think that was me. If it was me, I don't know how to get it off. Okay, so that's the bare bones. Okay, that's the bare bones. Is the passive accumulator. Okay, so what's step two? And by the way, might some people do that with some of their money? Maybe. Sure. Right? Why would they do that? Well, maybe because they don't want to actively trade all their money. Right? Maybe because they don't have the confidence yet to be super active. They think they're going to screw it up if they actively trade all their money. Right? Maybe it's because they don't want to be super aggressive and be a day trader with all their money. Okay. Maybe it's because they don't know any better. Right. So there may be a number of reasons. Okay. There may be a number of reasons. I remember back, I shared this story when I was on the Trading Justice podcast a long time ago. When I was in sports, I played baseball, and my dad was my coach growing up. And he would always say, whatever you are, be a good one, right? Whatever you are, be a good one. And so it's like, look, I mean, if you are going to do this passive investing deal, there's a right way and a wrong way, right? And so my short little blurb on the right way would be this step 1, 2, 3. The wrong way is you put all your money in stocks and then you panic and sell when they're down 50%. That's the wrong way. Okay. So, I mean, if you're going to do it right and figure out, how to do it right. Okay. Number 2, cash flow generator and volatility dampener. I thought that would be a good little header for this. So step 1, build a diversified portfolio of stocks or ETFs that have options listed. Okay. So maybe that's 10 different stocks. Maybe that's 10 different ETFs, like the S&P and the Dow and emerging markets and all these other areas that you can invest in. Step 2, sell covered calls on a monthly basis to reduce basis. I didn't write that very well. That missed the editing board there. Basis twice in four words. That's pretty pathetic. Who's writing this thing? Sell covered calls, I would have said every month to reduce your basis. Okay. Increase the probability of profit, enhance returns, and dampen volatility. So we're going to try to use covered calls to improve our performance, right? Step 3, maybe we can buy protective puts to limit risk. That way, if a bear market strikes, we don't lose 30, 40, 50%, right? So we can still invest, but try to minimize the downside. Step 4, invest more money in that portfolio each year to accelerate the growth and try to compound it, because every time you buy an extra 100 shares, you can sell one more covered call, right?